Hi, everybody, and welcome. This is Leslie with the New Mexico Small Business Development Center, and I'm always proud to introduce everyone to Tommy Thompson because he gives such great information. He has so much information to give on cash is king, cash management for your small business. And it's exciting because you can ask questions throughout the entire webinar. So if you have questions, type them into the Q&A and Tommy will pick them up. We'll either try to slip them in or he'll do them at the end. Also, I want to remind everyone the New Mexico Small Business Development Center strongly encourages New Mexico small businesses to be aware about the rest of their cybersecurity. We have a list of on-demand pre-recorded cybersecurity webinars on our YouTube channel, and I'll make sure everyone gets that information. Tommy, let's talk about cash is king. Turning it over to you.
Leslie, thank you very much. Looking forward to talking with y'all this morning. As Leslie said, my name is Tommy Thompson. I'm a SCORE certified small business mentor. The SCORE Association, like NMSBDC, is one of the organizations that small business owners can turn to for guidance and coaching and making their business look and perform better. A few guidelines this morning. First of all, your audio was muted already, so don't worry about that. If you set your zoom ratio to fit window so it fills your screen, you'll be able to see some of the smaller print on our specific cash flow forecasting template we'll be talking about later. As Leslie said, we will be using the Q&A function to take questions. If you would, when you write down your question, please write down the related slide number so we can go back to that as we need to. That's a good thing to remember. As far as I'm concerned, I'm a retired financial executive. I've spent most of my career as a corporate financial troubleshooter, whether as a consultant or as an employee at the C-suite level. I get to put a lot of letters after my name. Some of them are CPA and MBA and things like that. But at this stage, they don't matter as much. What we're here to talk about today, though, is how cash can keep your business running or bring it to a crashing halt. What we're going to address today, first of all, are the training offerings and counseling assistance available through SBDC. We're going to talk about today's objectives for this program. Then we're going to talk about this program. We'll take your questions and talk about a few next steps that you can do today to get started on managing cash flow in your business. First of all, for training offerings and consulting and counseling assistance, you can use the SBDC website at www.nmsbdc.org, nmsbdc.org. Yes, I can say that. To request no-cost business counseling, loan application assistance, to find training offerings for cybersecurity and pandemic response in these strange times. All of that's available there as our recorded versions of this webinar, also on the YouTube channel, as Leslie mentioned. Now, today, what we're going to talk about is cash flow. Cash is the lubricant of business. It keeps the gears moving freely and helps keep your business operating freely. We're going to talk about what is cash flow from a definitional standpoint. We're going to talk about what makes cash flow through your business. We're going to talk about some strategic principles of managing cash flow. And we're going to talk about tactically specific things that help you to understand your cash flow, to forecast it, to manage it coming and going. And finally, we're going to say a few words about some of the record keeping requirements for all the different pandemic relief programs that are out there. If you've taken advantage of many of them, you know that you've got some specific issues to deal with in terms of record keeping, and we're going to talk about what some of those are. First of all, as I said, cash is king in your business. It's the lubricant that keeps things flowing freely. And when that lubricant goes away, when you run out of cash, you will crash, because without cash, you have no way to equate the economic value that you're providing your customers and that they're providing to you. So the biggest thing about cash is to keep it in the front of your mind all the time. First of all, let's define it. What is cash flow? I like Yogi Berra's definition, and they pay in cash, which is just as good as money. Yogi was known for his pithy sayings, and that was a short one that bears on our issue here. In a more formal way, cash flow is the net amount of cash and cash equivalents. That's stuff that turns into cash overnight or immediately, that are transferred into and out of a business. Notice that I said transferred into and out of a business. That's not the same as cash coming from sales and profitability. At the most fundamental level, a company's ability to create value for shareholders, that's you, is determined by the business's ability to generate positive cash flow over a long period of time, to maximize long-term free cash flow. When I say free cash flow, this is cash that's not required for any other purpose in the business. It's not required to expand it. It's not required to operate it. It's not required to pay back debt. It's not required for any other obligations the business may have acquired. It's simply the net profit, positive cash flow coming off the business that isn't needed by the business. Now, what makes it? First of all, as you might think, it's cash money coming in, greenbacks, dollars, checks that you can put in the bank. And those come from cash sales. If you're a cash business, it comes from collections on accounts receivable. If you make sales on credit to customers, you have both cash sales over your counter and then people who pay you on their promise, who make good on their promise to pay you in return for getting shipped goods. Cash comes in from deposits, people who make a deposit against some future service or as security against some future service you're going to provide them. Prepayments for that service or prepayments for goods, cash with an order before the goods are shipped, for example. Cash also comes in from other sources that aren't related to the operation of the business so much as they are to its maintenance of financial health. And those include pandemic relief loans and grants. The Payroll Protection Program is the primary example there, as is the SBA's longstanding Economic Injury Disaster Loan Program, or EIDL, also pronounced EIDL. Also, you have bank loans that bring cash into the business, loans from yourself. You write a check to the business to keep it going, and money from family and friends and fools who invest in your business or will lend you money to get through a cash flow crunch, or maybe it's part of your permanent financing and part of your strategy to have family money in the business. Money going out includes compensation, right? The weekly payroll, the biweekly payroll, whatever your period is, benefits and taxes, payments on accounts payable when a vendor gives you credit and you promise to pay them in exchange for goods now. It includes rent to your landlord. It includes all the operating expenses that go into making a business operate. It also includes bank loan repayment. Now, these are not profitability items, but they do require cash. Repaying a bank loan, both the principal and the interest, takes cash out of the business. So does buying capital equipment to keep you either running the business as it was running or to help you expand by expanding your capacity. Owner draw, taking money out of the business so you can buy groceries, is another kind of cash money going out the door. And whether that owner draw is accounted for as compensation, part of the operations of the business, or whether it's a draw that represents a removal of excess cash from the business, is often your judgment. Similarly, money going to family and friends and fools in terms of dividends or interest on loans from them and so forth, takes cash out of the business. Now, it's important to recognize that cash flow is different from profitability. Profitability is what you measure and measure the operations of the business producing. Cash flow has more sources, as we just saw, and more uses, as we just saw as well. Paying back a bank loan, other than the interest portion, is not an operating expense of the business. It's a repayment of an obligation. Now, what isn't part of cash flow? First of all, when you send goods out the door in return for somebody's promise to pay you, that's what happens. The goods leave, no cash moved, right? And they're going to pay you sometime in the future. That's when the cash moves. Purchases on credit, similarly, when you get goods from a vendor before you have to pay for them, that is cash flow, but it's not part of profitability. So it's important to recognize that you measure cash flow basically by the money coming and going. Now, after we understand what cash flow is and what makes it happen, now we got to talk about the principal strategy related to cash flow. And the principal strategy related to cash flow is to work at it. Just like you work at your business. Excuse me a second. Just, well, 1 second, please.
Call from Pacific News.
Please forgive me. I apologize for that interruption. We were talking about cash flow strategy. The principal thing is to work at it. Keep it in the top of your mind. It's every bit as important as finding new customers. It's every bit as important as servicing your existing customers and improving your goods and services strategies with them. You have to work at it and have it in the top of your mind all the time. How does this business decision affect my cash flow? Should be one of the questions you're always asking yourself. Now, to work at it, the first thing you need to do is to forecast it. What's my cash flow going to be? And we have to look out into the future and make some assumptions about what's going to happen out in the future in order to see when we might have a cash flow problem. The sooner we see a cash flow problem down the road, the sooner we can start working on solving that cash flow problem. And forecasting is the way we start out to get there. Now, as we move through our forecast, we want to track our actual cash flow. We need to track it in order to compare it to our forecast and then understand why it's different. Trust me, it will be different. All right. And by tracking it, we learn things about the real world that may change our assumptions for our cash flow forecast going forward, because we don't just make one cash flow forecast and then live with that. We should be constantly updating that cash flow forecast every period in order to continue to look forward in the future. I tell all of my clients to forecast cash flow for the next 12 months out, and update that forecast every month for those 12 months and keep going after that, so that you've constantly got a rolling 12 months forward cash flow to play with. Now, once you can forecast it and once you can track it, now we can do things to accelerate the cash coming in and measure that. And we can do things to slow down the cash going out and measure that. Now, you notice I put a question mark after slow down cash out. You might ask, yeah, how do you do that? And we're going to talk about exactly how to do that in a few minutes. But these are the things you have to have in your mind. It has to be top of your mind. You have to forecast it. You have to track against it. And then you can use the techniques we'll talk about this morning to speed up your cash coming in and to slow down your cash going out. Now, forecasting, let's talk about that. Forecasting starts with understanding what's my cash available to me right now, available to the business right now, all right? And then what cash do I expect to come in the next period or 12 months of periods? Why is that cash coming in? And the why tells us something about whether or not we've got a plan to repay it later. And when is it coming in? When do I see this happening? Also, as well as cash coming in, of course, what's going out? Why is it going out? Is it going to turn around and come back in later? And when is it going out? And finally, when I net all the top three together, I get what's my cash expected to be then at the end of the forecasting period, or each of the 12 months in my rolling 12-month forecast. And setting one of these up is not too terribly difficult to do. And in fact, people have done it before, and we're going to absolutely use what's gone before us and talk about using a model similar to this as cash flow forecasting tool. Now, I'm very indebted to an author named Philip Campbell for this forecasting template. It comes from a book he wrote called Never Run Out of Cash. The book is available for free at his website, neverrunoutofcash.com. Obviously, he has other books he'd like to sell you, of course, but this particular one is free. And this template model covers 12 months. I've only put 6 months up here so that you can see the type being large enough on your screen. And this model comes in 4 parts. And we're starting out, as you can see here, with section 1. But just above, and section 1 looks a lot like our operating profit schedule. We've got revenue on it from sales. We've got cost of goods sold. We've got a gross profit line. We've got operating expenses, total expenses, and we've got a bottom line, all in this section 1. Now, the bottom line is labeled a little differently than it is in your profitability statement. Instead of saying net income from operations, it says EBITDA. Well, what's EBITDA? It stands for earnings before interest, taxes, depreciation, and amortization. And professional financial analysts often use EBITDA as a proxy for operating cash flow. In other words, cash flow from the business's own operations. And the reason they do this is because interest is assumed to be an expense of the investor. Taxes don't move but quarterly or thereabouts, and taxes are also, to a large degree, an expense of the investor. Depreciation and amortization represent the accounting for money that's been spent in the past, and therefore it doesn't represent cash moving now. There are some adjustments to be made, as you might guess, to section 1, and we'll get into those in a moment. But what we are trying to do here is to develop a proxy for the operating cash flow of the business. And that's what the EBITDA line does for us in section 1. Section 2 of this template is devoted to debt service. Now, debt service, whether it's principal or whether it's interest, doesn't matter from a cash flow standpoint. Okay? It doesn't matter because it's a check going out the door to the bank. And you'll notice here we've provided for 3 different kinds of debt service. You can fill them in as you wish when you use it. The live version of this template is available at the NMS-BDC website, and may also be coming to you with your slide copy after this program is over. Section 3 talks about investments. Section 2 is debt service, repaying debt we took on to make investments in the past. Section 3 talks about investments now and in the future. And these can include capital expenditures, a new copier, a new stamping machine, a new cutting machine, a new vehicle, a delivery vehicle, or a sales vehicle for the sales team. Those kinds of things go into section 3, and they're cash that goes out now, but they're not profitability items because they last throughout the period of your business operation. They last longer than one business operation period. When we get to section 4, which is the last section, now we're reconciling a lot of the things that are in the profitability statement with things that are more cash flow oriented. For example, when I send goods out the door, I'm sending them out the door from my inventory. Inventory was built up by spending cash in the past, right? So I'm going to add back the cost of goods sold because those represent inventory, goods from inventory, and not cash. What I am going to substitute for it is inventory purchases, and that's cash that went out the door this month for the purchase of inventory items. Similarly, in my sales, in this example, the business sells things on terms, on credit terms, so that it doesn't necessarily, sales don't necessarily reflect the actual cash. So I'm going to deduct the sales number from my EBITDA, and I'm going to add back the cash that's collected from sales over the counter during the month and collections on accounts receivable. These are collections where people paid us for stuff that we shipped out last month, the month before. We accounted for them last month or the month before as sales, but now the cash is coming into the business. The next line is estimated tax payments. Normally, we only make estimated tax payments on a quarterly basis during the year. These are estimated income tax payments. And to the extent that we make those payments, we record the payments when we make them as the cash they are. Normally, in accounting terms, we would accrue that tax each month. But that's not the actual cash moving. We just recognize the cost for financial reporting and tax purposes. We actually paid the money quarterly, and that's what this line does. The next line seems a little odd, but it makes some sense when you think about it. It measures the change in accounts payable. I have a level of accounts payable. I've promised to pay people on time for goods that they've sent me. If I pay down that balance of accounts payable, I've actually used up cash to reduce my obligation, haven't I? Similarly, if I let that accounts payable rise, I've received goods that I haven't paid for yet, and that's just like cash coming into the business. So if my accounts payable goes up, it's a source of cash. If it goes down, it's a use of cash. And that's what this line recognizes. We've thrown in a couple of other lines here for things that you might find in your forecasting that make sense. It totals off. And then the next line says net cash flow. Now that's the sum of the bottom line in sections 1, 2, 3, and 4. All right. If you add all that stuff together, you see that in January, we had net cash flow of positive $905. Hey, congratulations. We positive cash flow. That's a good thing. Now we take that $905 and add it back to our beginning cash balance of $10,000 in January up here, right? And what we wind up with is an ending cash balance of $10,905. Now, what we ended January with must be what we started February with, right? So our February opening balance is $10,905. We repeat the process each month. In this case, our net cash flow is positive through all 6 months. That's a great thing. And we wind up with a lot of cash by the end of the 6 months. You can see how it flows. The ending number for 1 month is the starting month number for the next, and so on, right out through your whole 12 months. Now, some businesses, you may be among them, you may not. Some businesses set a minimum cash balance target. And for a lot of them, that's the money they figure they need to run the business on a week-to-week or a month-to-month basis. I need that minimum cash balance to give myself a cushion in the fluctuation of the business cycle and so forth. Okay. I got to keep $8,000 in the bank. Maybe the bank requires me to keep an $8,000 minimum balance. All right. That's another reason for doing it. But when you take that minimum cash balance target and then compare that to your actual cash, you come up with a line that's labeled excess or shortfall in cash. And here the picture is pretty rosy in this example. I have excess cash every month, and at the end of 6 months, I've got quite a bit of excess cash. That's known as free cash. That's cash that I didn't need at that time to operate the business. I didn't need it to pay back debt. I didn't need it to pay for new capital expenditures. All that's accounted for back here in sections 2 and 3. So this is over and above what it took me to service my debt and to service my asset base, my capital productive asset base. So I can do a number of things with that. I could decide to reinvest it in the business, either in a marketing campaign from an operating expense standpoint, or in new equipment and machinery to expand my capacity to produce, or in new delivery vehicles to expand my ability to deliver quickly across a broader area, all that stuff. Or I could just take it out and put it in my pocket. Good thing, huh? So this is your forecasting tool. This helps you understand where money is coming from and where money is going on a monthly basis, looking out 12 months. Again, we put 6 here just so you could read the type if it wasn't too small. Now, once I have that, once I have my forecasting tool, I can look out in those months and I can say, gee, I've got a lot of excess cash here, or wait, I need a lot of cash this month. In the 1980s, I worked for a company called Gardenway Manufacturing, and they built the famous Troy-built rototiller for garden rototilling. And we sold tons of stuff between the end of February and the middle of May. And that was our big selling season, and the cash just flooded in the door. But from June until December, except for a little blip in late September, early October, we used cash. So our cash forecast was crucial to understand what our monthly burn rate was. What were we using in cash every month in those months when it wasn't flooding in the door? And we used forecasting tools like this to understand when we were going to have to borrow money at the bank and when we were going to have to when we were going to be able to pay back that seasonal borrowing and actually pay dividends to the shareholders of the company. So this was a vital tool that we used that you can use too to get a handle on when you think the cash is coming and when you think the cash is going. Now, once we forecast it, we need to track it. If you're using accounting software, and I hope you are, every major accounting software package lets you produce a P&L statement, profit and loss. It lets you produce a balance sheet, which is your financial situation, your financial condition. And it allows you to create a cash flow statement, which relates the P&L to the balance sheet and gives you an idea of how your cash is coming and going. Now, you can look at the format that your software uses, and you can modify that template we just were working on to mirror the cash flow statement format in your accounting software. Most accounting software also lets you change the cash flow statement format so that you can match it up to the two, so that you can track the two line to line. Now, when you track according to the same periods that you forecast the cash, right? Because if you created a forecast by week and you're tracking it by month, you've got to do an extra step to get 4 weeks to equal a month, right? So I tell everybody, when you track, start tracking it at least every quarter. More specifically, if you can, if it makes a difference, track it every month. And that gives you an idea of when you're going to be needing cash, and also how closely your forecast mirrors the real world. Because when you track it, you can then compare what's actually happening to the assumptions you made when you built the forecast. And you can use the actual experience to evaluate how good your assumption was, and whether you need to change that assumption as you update your forecast going forward. And after a while of doing this iteratively in a normal kind of business, you get pretty good at forecasting your cash flow based on assumptions you make about what really happens in the real world. Now, down there at the bottom, you see that last line. In an emergency, track your cash flow more often. Do it weekly. Do it daily if you have to. Again, back in the tiller business that I was in the 1980s, our marketing department used direct mail marketing techniques to sell the product directly to the retail consumer. We didn't go through dealers or distributors. And what it knew from prior experience was that within so many days after it put a big promotion in the mail, they would start getting orders. And they budgeted that during the year, and they planned it during the year, and that went into our corporate budgeting as revenue, as sales revenue, because we would get orders in the door with deposits or with payment, and then we would understand roughly when we were going to ship those orders out, usually within a period of short period of a week or 10 days. And then we knew that if we weren't tracking to the order flow that was forecast, we knew we had issues that we were going to have to deal with down the road. All right. And so our marketing people would track the order flow against their planned order flow every day. And they'd let people know about it. So we in the financial department knew that we were going to have to borrow or not borrow, depending on when, and so forth. And that helped us make management decisions for the financial health of the company. Now, once you're forecasting it and once you're tracking it, what do you do to change it? And we're going to talk first about getting cash flow in faster, accelerating your cash flow coming in. Now, the best way to do that is to look at your existing customer base and sell, sell, sell. Analyze your existing customers. Analyze what they've bought from you. Call them up. Communicate with them. Offer them more of the same, or offer them related products that could improve their business. When you do this, it's always good to have a promotion in mind, right? You offer them pricing discounts for fast payment, faster than normal, like cash with the order payment, All right. If you'll send us cash with your latest order, we'll give you 5% off instead of the usual 2% for paying in 10 days. All right. You also want to continue marketing and prospecting. We're going to talk about cutting expenses later, but one of the expenses that you should be very careful about cutting is your marketing and prospecting expense, because your existing customer base will erode over time. It'll peel away. People will retire, they'll die, they'll sell their businesses, and the new business will get a different vendor for what you've been selling them. Some customers will answer the call of a different vendor offering them a cheaper product or a cheaper price, and they'll go away. So you still have to continue marketing and prospecting, both to acquire new customers and to remind your old customers that you're still in business. Because if you stop marketing and prospecting, you can be sure that your competitors are all going to be talking to your customers, and they're going to be telling your customers, well, look, they disappeared. You don't see them advertising anymore. They must have gone away. Why don't you buy from me? So that marketing and prospecting is still a critical function in your business that has to be maintained. Now, I tell people, use one bank, and use just the one bank, because everything coming into one bank means you have faster availability of your cash. It may only be a day or two, possibly 3 in some cases, but in general, you get faster availability by concentrating your cash receipts into one bank. Then, to accelerate your cash flow coming in, if you have to, borrow money. Match the type of loan to what it's paying for. And when I say that, I mean, for example, if you have a great month and you shipped out hundreds of thousands of dollars worth of goods to customers, but they haven't paid you yet, their promise to pay is a financeable asset. You can borrow money against that promise at your bank. The usual way you do that is to establish what's known as a revolving line of credit. A revolving line of credit is a short-term credit line that you borrow from and pay back as your customers, as you ship to your customers and as your customers pay you. Similarly, you can also use that revolving line of credit to fund inventory purchases to the extent that your inventory exceeds the amount of credit that your vendors will extend to you, right? That's all short-term stuff. If, on the other hand, you need cash, and you need to get cash in to pay for a new vehicle that you're buying for the business, then that type of loan might be a term loan over a period of time, like the useful life of the vehicle, 4 or 5 years. And so you're matching the loan period and the loan character to what it's paying for. And that's a way to bring money into the business. Yes, you have to pay it back, but you don't have to pay it back all at once. You can pay it back as you're able to, as your customers pay you, or on a monthly basis, like we're all familiar with. Also, you can work on collecting those receivables faster. You can use professional collection techniques to keep in touch with your customers, to stay so that your business stays in the top of their mind when it comes to getting paid. Now, those collection techniques can be a variety of tools. First of all, you can review your customer base, and you can start to tighten your credit requirements. You can reduce the amount of credit you extend to some of your customers, the ones that are the slower payers perhaps. By reducing the amount of credit they're open to buy, they have to pay you more often, right, in order to stay within their credit terms. And to do that, all you have to do is to say, we've done our periodic review of our customers and customers' credits, and we've reduced your open to buy limit by X dollars or so much. And they have to pay you a little faster if they're going to continue buying from you. You still have to coordinate with your sales team to get them to like this idea. Well, to get them to accept it anyway. Your worst payers, you might have to say to them, I'm sorry, we can't extend you credit terms any longer. We will take a credit card with the order, which is payment with the order. The credit card company will pay us in 2 or 3 days based on our credit card deposits, right? And finally, communicate. You have to talk to your customers. You have to call them, you have to follow up, you have to be proactive in talking to them. Now, you don't have to talk to them like, hi, are you going to pay our bill? You can call them up and find out and talk to them a little bit about how their business is doing, maintaining a relationship that is built on a mutual benefit, mutual trust kind of basis. And when you do that, when you're in constant contact or relatively constant contact with your customers, you learn more about how their businesses are going, and they in turn get your business top of their mind, in the top of their mind, as for when it comes to who they're going to pay this month. All right. Now, we talked about revolving lines of credit. Another short-term financing method is called factoring. And this is very expensive to use, and it's fairly uncommon outside of, say, the fashion industry or other industries where there's a long stretch between the actual goods shipment and getting paid. In the fashion industry, you might ship goods to your department store customers in August that they'll then sell through the fall into the winter, and then they won't really pay you for those until late in the fall or early in the winter. And for the small businesses that make up many of the companies that supply fashion clothing to the industry, that's too long for them to extend credit. So what they'll do is they'll take the invoice that they issued to their customer and they'll sell it to a company called a factor. Now, the company will buy it for a portion of what the invoice total is. If the invoice is for $1,000, the factor company might pay them $750 for it. And that difference, that $250 discount, accounts for the factor's capital time value of money and also their profit margin, because they won't necessarily collect all those invoices when time comes to be paid. And there's a risk there that they won't. And there's a cost of capital they have for them to finance this purchase of invoices. So that's the reason that you get an expensive service there, okay? But it is a possibility in certain kinds of industries, in certain kinds of cases. Also, I tell folks to use a lockbox service. If customers are mailing you payments, rather than having them mail them to your office and have your staff process them through your accounting system and then take them to the bank, they go straight to the bank in the first place. All right. And when they go straight to the bank in the first place, you get spendable credit in your bank account faster. That way, the lockbox, once the bank processes the deposit, then they forwarded all the materials that come with those checks. They forward them to you, and then your staff can process them on your time, not on the time of the bank, because the bank will normally take 2 or 3 days before it gives you credit for check deposits, and it can take 2 weeks sometimes for a full cycle to for example, to turn up a bad check, which goes to the issuing bank. The issuing bank dishonors it. It's charged back to the deposit bank, and it's charged back to your account. All right. So using a lockbox service gets that collection period, that 3-day or 2-day, whatever period, started faster. And that gets you your cash available faster. Now, at the same time, we're trying to accelerate cash coming into the business. We're trying to decelerate cash going out. It's easy for me to say, right? Well, you can do it. You can do it, but you have to do it carefully. And communication is key here. You have to analyze your vendor list very carefully. Some of your vendors will be people you absolutely want to stay on the best terms with. You absolutely want to pay them exactly according to your credit terms with them, because otherwise they'll stop shipping you and you'll go out of business because you don't have the goods to service your customers with. All right. So there's that group. And then there's another group. You don't buy from them quite as often. They're not quite as important to your business. Maybe you can slow pull them a little bit and come up with them a little later. All right. And there may be 1 or 2 classes of that kind of vendor. I call them your A's and B's and C's. The key to all this is to communicate with the vendor and tell your story. Hi, Mr. Vendor. My accounts payable, my cash flow forecast says I'm going to have a rough couple of months here. I'd like to slow pull these invoices and catch you up on X date past my rough patch. All right. And when they hear that you have a cash flow forecast, they know that you're proactively managing your business. You're looking out for it. You're being smart about managing your cash. And they're more likely to work with you than if you just don't pay the invoice for an extra 10 days. All right. When you don't pay the invoice, vendors get nervous. They start to think, will he ever pay the invoice? He's always paid on time before. Now he's paying late. What's going on? Is his business going down the tubes? Should we stop shipping to him now? And that's what communication forestalls. By telling your story up front, promising a specific period of time, promising a payment, right? You get their trust. You increase their trust. You increase their confidence in you as a business person with whom they can deal on a business-like basis. All right. And communication is key there. Now, as well as slowing down our accounts payable purchases, our accounts payable payments, sorry, we have to cut expenses sometimes. Well, yes, it's easy for me to say, but just like we analyze the vendor ledger, we analyze our expense ledger. We analyze our payroll carefully. We analyze all of our outsourcing opportunities. All right. And we look at the things that we're doing very carefully. Do we have to do that this month? Do we have to do that for the next 6 months? What are our people doing? Can we temporarily jam 2 jobs into one person? And I say this as somebody who's had to do it. The hardest thing to do is to say to a good, reasonably performing employee, I'm sorry, I don't have a job for you. It's tremendously difficult, but it has to be done, or may have to be done, to save the business so that the business keeps operating. So whether it's a layoff or a furlough or some other means of reducing the payroll, you do have to analyze it carefully, see what functions those folks are doing and what functions you can do without for some period of time. All right, very difficult. Also, when you analyze outsourcing opportunities, think about the core of your business. Think about the place in your business where you add the most value to your customer. Why are they dealing with you? What do you offer them that makes their life better? That's where your value is added. In a manufacturing business, it may be in manufacturing. It may be some advantage you have in manufacturing or technology. It may be some advantage you have in marketing, sales. It may be some advantage you have otherwise. But you have to look at those opportunities to outsource everything else. You can outsource payroll these days. You can outsource your accounting function these days. You can outsource your human resources function these days. You can even outsource your marketing and sales function these days, or your manufacturing function, if that's not your principal value add. Okay. Look at doing that. Look at the cost of doing that. It will cost you possibly more than if you have employees inside, but it can also be more flexible. You can increase or decrease the amount of that activity more easily, perhaps, than if you had staff and expenses built into your business to do it. Finally, think about just doing without. Okay, for the next 6 months, we aren't going to do X, period. Just not going to do it. Can't do it. And it's a hard decision to make, as I said earlier, but it may have to be done in order to keep the business afloat. Now, I said finally just before, I was lying. Finally, as I said earlier, don't eliminate marketing. You can cut it down a little bit. You might not put out one particular promotion. You might not put out one particular awareness campaign, so to speak, that lets people know you're in the market. But don't eliminate it. Keep your visibility in the marketplace up. In whatever fashion you've been keeping it up, keep it up. Maybe you don't keep it up quite as extensively, but you still have to acquire new customers. Keep that in mind all the time. Now, there are emergencies. There are things you do normally, and there are emergencies. And in an emergency, all bets are off. Decelerate your cash going out. Do it quickly. You may need to go to a vendor, negotiate with a vendor, you negotiate with your landlord. The message is the same. And remember, it's a message, it's a communication, right, with your landlord and your vendor. You go to them proactively and say, my cash flow forecast says this is an emergency and I need to delay my payments to you. I will catch up after the emergency, right? With your landlord, you might say, I need 6 months of rent forbearance and we can amortize it over the remainder of the 4 years of my lease or 5 years, whatever, right? You don't want to delay and then catch up later. With your vendors, the same thing. If I can have an extra 4 months, if you can carry me for 4 months without any payments, I can pay you back beginning in October over a 2 month or 3 month period. That's when my cash flow problem is going to be going away. Similarly with your bank, if you have a loan with the bank, approach them before you have to skip a payment and say, here's my cash flow forecast, here's what's going on. I need some forbearance for a month, 2, 3, 4, and we can catch up by making double payments beginning in December or January or whenever it is. In all cases, communication is the key. You've got to communicate with your customers. In the same way, you want to try and accelerate the cash coming in by getting cash from your customers, if at all possible. Prepay a service contract. I'll give you 14 months of service for 12 if you pay me now. Prepaid subscriptions. I'll give you 14 months of that service if you pay me now. Gift cards, which are very popular in restaurant circumstances and some kind of retail stores. Pay me now for the gift card. I'll provide you the goods and services later. If you do business in contracts with customers, if you're starting new contracts, it's entirely reasonable to ask for an advance contract payment to work off against over time because you often have startup costs associated with that contract. Also in an emergency, look to the programs that have been put in place for it. During the pandemic, billions and billions and billions of dollars have been put aside and made available to small businesses and large businesses for disaster and relief loans and grants. The state of New Mexico, the city of Albuquerque have had grant programs. The Small Business Administration has had the EIDL, the IDL loans, and the PPP program, the payroll program. All of those are ways to get money in the door. And you don't much care about where it comes from because the survival of your business is what's at stake. So accelerate what you can. It may take a little longer than decelerating because you're going to spend more active time on the deceleration negotiations than you did perhaps. But in all of this, you need to think top of mind what gets cash in faster and what slows it down going out. Now, taking advantage of pandemic relief programs like grant programs and loan programs requires you to keep records. You, first of all, your basic business bookkeeping for operations, you have to stay up to date because there are odd dates buried in many of these relief programs. For example, the initial payroll protection program dates were, some of the dates included February 20th, April 25th, April 10th. Those were odd dates that were not necessarily your month-end fiscal date, okay? So you have to keep those in mind and keep your bookkeeping up to date to recognize so you can pull information off it according to the dates that are required by the relief programs. Each of those programs has specific requirements for what the money's for and what you get to spend it on, okay? When you see that, you can help track it through your existing accounting system by establishing new sub-accounts for each loan or each grant. A sub-account for the cash coming into the business and a sub-account for how the money was spent, whether it was spent on payroll or on rent or on inventory or on whatever operating expenses that you spend it on. Because I'll guarantee you, after a while, after this all subsides, and even now as before it subsides, audit agencies from the people who are creating these programs, who are administering these programs, are getting ready to come out and audit the recipients. Will they audit everybody? Probably not. But will they audit you? There's a good chance they might. And so you have to be prepared with the right record keeping for that audit process. Now, that audit process goes beyond bookkeeping, okay? It goes beyond just you handing them a report from your accounting system. They're going to want to see the payroll records, the leases, utility bills, invoices, all the stuff that backs up what's actually in the accounting system. They're called original entry documents, okay? And those are evidence from a third party, your lease with your landlord, a utility bill from P&M, an invoice from your inventory supplier. Those are third party attestations that this is an actual expense and it was actually done. And similarly, your checks canceled, run through the bank, returned by the bank, your checks are evidence of payment of those. All right. So you have to have that original entry document, evidence of payment receipt, to satisfy auditors. And the sooner you get your bookkeeping up to date and the sooner you establish your files, your actual document files, the sooner you'll be able to just say, oh yeah, here's the files, go ahead and audit. And you take very little time away from your business to do that. So keep that in mind. All these programs, if you get any relief from them, you will be expected to account for in detail what it was you got and what it was you spent it on. Now, to do that, the best way to do it is to work with your CPA and or your bookkeeper. These are folks who are trained to keep records. They're trained in how to set up record keeping systems. They're trained in how to account for separate sources and separate uses of funding. So you working with them, even if it costs you a little bit of money, is going to be well worth it in the long run. Now, I'm not going to go through this in detail. It's a lot of small print. This is included in the slide deck that you're going to get sent to you after the program. And these are some more resources for you to get more familiar with how cash flow works and how to manage your cash flow in a better fashion. Also, COVID-19 business resources put out by New Mexico. There's OSHA guidance on this. There's CDC COVID-19 information. There's new information just this morning about booster shots and things. There's a whole lot of information on the Equal Employment Opportunity Commission website. That's eeoc.gov. And then New Mexico's COVID-19 business resources down there at the bottom. Again, this is all in the material that you'll get. Contact information for SBDC, go to the website, nmsbdc.org, email info@nmsbdc.org, or call either of the two phone numbers that are there. The SBA, I have to warn you before you try and contact them, the SBA is feeling quite overwhelmed lately. The website, sba.gov, is the entry portal for the entire SBA website. Their disaster customer service address is written right there. And that phone number also gets you to their disaster customer service group. The EIDL loans, EIDL loans, are made directly by the SBA. Now, there's no bank involved. The PPP loans involved banks as the making organization and as the forgiveness processing organization. The great thing about a PPP loan is if you spend it on the right stuff in the right proportions, it's completely forgivable. And the applications to forgive go back through the bank that issued you the loan in the first place. And I highly recommend that you, if you have a PPP loan, you get working on your forgiveness applications right now for it. Now, we've given you a lot of information. I want to acknowledge Philip Campbell again on his Never Run Out of Cash book, very handy. The National Federation of Independent Businesses contributed material to this seminar's creation, as did Inc. Magazine's Business Archives. And we put it all together through the SCORE Association's Albuquerque chapter, of which I am a member. Those are the organizations that we really want to thank deeply for a lot of the material that went into this program. Now, who has a question? I'll let Leslie come back in here. And
Okay,
whether we
so
have any questions, we have a couple of items in chat, and they're from Leslie.
they're from me.
But if you have a question, take a moment now, just write it down. I'll wait. I'm not going anywhere for a while. And
While
happy to address them.
while they're putting their questions in the Q&A, if any questions come in, I do want to remind everyone that we do have Tommy again in a couple weeks. So if you think of everything, once you get the handout or anything, you can always come back, bring your questions in, and he can answer them anytime. I want to remind everyone that we have some other webinars coming up. We have Who's Stealing My Art, Online Plagiarism, E-commerce, Alternative and Selling Methods, Basic Steps to Starting a Business in New Mexico. We have Vic Bernaclaw, one of our other SCORE volunteers. He's going to be giving us a how to create a business plan, and it's a two-part series. So the next part after that will be implementing that plan. We have a bilingual session on accessing financial resources, and we have phone app, Is It Good for Your Business? And I think that's it for today. Tommy, do you have any last wrap-ups?
I want to say that I'm first of all, I'm not that good, that there will be questions. You can watch this seminar again on NMSBDC's YouTube channel. You can submit questions to SBDC, they'll forward them to me. But if we don't have any questions at the very current instant, then I want to thank you all for your attention today. We're going to move on and talk about what's next. What you can do today is to go home, pick up that forecasting template off the NMSBDC website and start using it. Populate it, fill in your information, make your forecast going forward. Set up so you can track your forecast going forward. Do that today. It's that important, especially with the various disruptions that the pandemic has created in everybody's business life. But start it today. Just start it. Because the sooner you start it, the sooner it has value to it, the sooner you can use it to help make your business better. Now, you're going to get a couple of things after this. You can go to the NMSBDC website for further training, business counseling, loan application assistance. There are links to a variety of other resources there as well. And also, I really want to ask your favor here. You're going to receive a survey via email after this presentation. That survey and your responses to it help both NMSBDC and me personally, because the feedback we get from the surveys helps us to modify this program to better meet your needs and to better meet the needs of folks like you who are going to take this in the future. Your reactions to this are much appreciated, and we thank you for returning that survey when you see it later. With that, I want to say thank you very much. I appreciate your time today. Use all the resources we've given you. Go forth and forecast your cash flow. Manage it better. Thanks, everyone.
Thanks, Tommy. You guys have a great rest of your week. See you later.